A lot of boutique owners sit down to do their bookkeeping and record every single dollar that goes out of their bank account as some type of expense. Money left, so it must be an expense, right? But here's the problem with that. If you're recording things that aren't actually expenses into your expense accounts, your P&L, which is your profit and loss report, is going to show you a lower net profit than what's actually real. And I know that might sound like a good thing at first, like, great, lower profit means lower taxes. But it doesn't actually work that way, and here's why. Number one, if you try to actually claim all those expenses that aren't actually expenses on your tax return, you're falsely lowering your net profit that you're taxed on. Now, are they ever going to catch that? I don't know. But if they do, you're going to owe additional taxes on the amounts you tried to slip by as deductions, plus probably some penalties and interest. Number two is if your books are showing a lower profit all year because you're recording all of these expenses, you could seriously underestimate what you're going to owe come tax time. Maybe you hand your financial reports to your tax preparer and they catch that these things aren't actually expenses. And as a result, your bottom line net profit is a lot higher than you thought, and you just, frankly, weren't prepared to have this giant tax bill that you weren't really planning on. So getting these 7 types of transactions categorized correctly throughout the year is what keeps your numbers accurate, and it gives you the clearest picture of your taxable income and just your bottom line profit throughout the year to help keep your bookkeeping and your tax prep as stress-free as possible. Let's dive in. Hey there, and welcome to the Boutique Bookkeeper Show, where we take the mystery out of your money and make your numbers make sense. I'm Megan, virtual bookkeeper and bookkeeping coach, and I love helping female boutique owners just like you finally feel confident about the financial side of your business. If you're tired of feeling anxious every time you have to open QuickBooks, or if you're making sales but constantly left wondering, where did all that money go? You're in the right place. We'll cover all things bookkeeping and taxes, all in plain English, so you can be less intimidated by the numbers and finally start to use them to help you grow a profitable boutique. So, if you're ready to stop avoiding this whole numbers thing and start keeping more of the money you make, grab your coffee and your calculator and let's dive in. Hello, and welcome to another episode of the Boutique Bookkeeper Show. I'm Megan, and today we are going to be talking about the 7 different ways that money leaves your boutique, and more importantly, why not all of it should be recorded as an expense. And I want to kick this off with a real story because I think this will help some of you understand just why this really matters. So, a couple of years ago, I came in to do a cleanup for a business owner who she had been doing their bookkeeping throughout the year. She was categorizing all the transactions, she was reconciling all the accounts. But every single time that money left her bank account, it got categorized as some type of expense category, meaning that it showed up on her profit and loss report to reduce the income. Every single transaction. So at the end of the year, when she pulled her P&L, it showed that their business had been operating at a loss of about $50,000 throughout the year. And that's what she truly believed. That's what her reports told her. So she assumed that she would owe nothing in taxes because why would she if she lost money? But after I came in and cleaned everything up and got all of the transactions correctly categorized, she actually had a profit of about $50,000. So that was about a $100,000 swing in her net profit just from fixing how things were categorized. And because she had assumed all year that she wasn't actually profitable, she hadn't set aside a single dollar for taxes. So not only was just the bottom line number a shock, the tax bill that came along with that number was a bit of a shock too. And that is why this stuff matters, because it allows you to see just what's actually going on with your business. I mean, she'd been assuming this whole time that her business was operating at a loss, but it also allows you to be able to do a little bit of planning and preparation for tax time. So before we walk through all 7 of these categories, I want to give you a quick tool that you can use inside of QuickBooks to always know where a transaction is being posted and showing up on your reports. And it's called your chart of accounts. It's basically a master list of every account you use to categorize your transactions to. If you want a more detailed walkthrough, you can actually go back and listen to episode 2, where I did an episode entirely on the chart of accounts. So I will make sure to link that in the show notes below as well. But if you're in your QuickBooks and you open up your chart of accounts, you're going to see a couple different columns, but the two I'm going to focus on is the account name and the account type. The account name is what you're going to see anytime you are categorizing your transactions in the little drop down. It's like the pick list of what you want to categorize a certain transaction to. But the account type is going to tell you the type of account you're working with. And really, that's going to fall into two different buckets. The first bucket is your balance sheet account. So that's going to be anything that is an asset, liability, or equity. The second bucket is all of your P&L accounts, meaning anything that flows through onto your profit and loss report. So any income, cost of goods sold, expenses, or they also have other income and other expenses. So all of those, if an account type is income, cost of goods, or expense, it's going to show up on your P&L report and lower that taxable income. So anytime that you're not really sure where a transaction is landing, just pull up your chart of accounts and check the account type. And anytime during this episode that I refer to an expense account or an asset account, I'm referring to an account that has an expense account type or some type of asset account type in your chart of accounts, because that's what tells us where it's landing on your financial reports. So with all of that out of the way, let's walk through these 7 types of spending one by one so you know exactly where every dollar actually belongs. So number 1, and this is the one that most people are probably already familiar with, and these are your true expenses that show up on your income statement. These are your operating expenses. These are going to be all of the everyday costs of keeping your store up and running. So think things like rent, utilities, software subscriptions, apps, advertising, office supplies, your bookkeeping software, basically anything that you spend money on just to keep the lights on and the doors open. These are going to be deductible in the year that you pay them, and in QuickBooks Online, they get categorized directly to these expense accounts, which means they show up right on your profit and loss report. They're pretty straightforward, and this is also the category that most boutique owners are overusing because they're dumping things into these expense accounts that don't actually belong here, they belong somewhere else. Which leads me into category number 2, payroll expenses. Now, payroll is technically a type of operating expense, but it has enough going on in the background that I want to pull it out and talk specifically about payroll separately, because there's some things that you want to make sure that you are getting right here. So the big one here is that you want to make sure that you are recording the gross wages as the expense and not the net pay that actually hits your employees' bank accounts. And on the payroll tax side, you want to make sure that you are expensing the employer portion of taxes as the expense, not the total taxes that are also withheld from your employees' paychecks. And here's kind of why this matters. So if you're using a payroll provider like Gusto or ADP, which, great, I love them, typically what they do is they pull 2 separate withdrawals from your bank account. One that matches the total net pay that's going to be paid to your employees, and another one that is the total taxes, which is going to include the taxes that you have to pay as the company and the taxes that were withheld from your employees' paychecks that you will have to pay to the government agency. And if you just record those $2 amounts as your expenses, so the tax one as your tax expense, the net wages as your gross wages, the numbers on your P&L report are not going to match the tax form W-3 at the end of the year that gets issued. And your tax preparer will probably notice, they'll probably have questions, it'll create extra work. So if you just make sure that you are recording the correct amounts at the time, gross wages and employer taxes are the 2 pieces that you need to make sure that you are recording. The easiest way to do this is just via a journal entry. You can set up a template in QuickBooks where you debit gross wages, debit your employer taxes portion, then you credit your total tax liability, meaning the employee and employer portion, and credit the net pay. That way, when the transactions are actually coming out of your bank account, you can categorize those to those liability accounts as well to kind of zero them out. All right, category number 3 is inventory purchases. So when you purchase inventory for your store, that is not or should not be recorded as an expense because it is an asset. So when you buy inventory, right, that's something that you own. It's sitting on your shelves. It belongs to your business. It has value. So until it actually sells, it lives on your balance sheet, which is basically a snapshot of everything that your business owns and owes, and it should be represented as an asset in your inventory asset account. It only becomes an expense, specifically cost of goods sold, when those products are actually sold. So I did a whole deep dive episode on cost of goods sold versus inventory back in episode 31. So if you want a deeper dive on that and why it matters, you can go back and listen to that episode. I'll link that in the show notes for you as well. So anytime you are buying inventory, it should be categorized to an inventory asset account. All right, number 4 is paying yourself. And this one is so important, and I get questions on this category quite a bit. And this part, it will depend on the entity type that you have. So if you are taxed as a corporation, meaning you have elected to be an S Corp or a C Corp, then how you pay yourself should actually be captured in the payroll category, because one of the requirements of being taxed as a corporation is you need to be on payroll. So this section specifically is going to be anyone that is just a sole proprietor, single member LLC, and that is the amounts that you actually pay yourself are not a deductible business expense. They are what's called an owner's draw. I know it feels like an expense. You're paying yourself for all of your hard work. The money left your account and went to you. But from a bookkeeping standpoint, it is not deductible. So it should not show up on your income statement. Instead, the account type should live in the equity section of your balance sheet. And the equity section is basically just what's left over for you as the owner, all of the debts paid, and if you're taking money out of the business, there's less left over for you. So this also applies to any time you accidentally or on purpose use your business bank account or card for something personal. Those transactions also get categorized to owner's draws, so they don't show up as a business expense and mess up with your numbers over there. So in QuickBooks, you'll have an owner's draw account set up under your equity section. Just make sure that it doesn't say expense account, it's an equity account. And if you want a deeper look at how paying yourself actually works in your boutique, you can go back and listen to episode 22. I'll link that one in the show notes as well. All right, next category, number 5, is asset purchases. So every now and then, you're going to need to buy something bigger for your store. And when I say bigger, I mean more expensive. So maybe a new point of sale system, a laptop, a whole new shelving and display fixtures. Maybe even eventually you buy the building that your store is in. So I just want to be clear that this applies to more physical things that you purchase, not necessarily like an expensive service or advertising package or anything like that. So if you pay, say $5,000 for an advertising package, that's still an operating expense. But when you're buying a physical item and it crosses a certain dollar amount, so generally speaking, anything over maybe $2,500, it doesn't necessarily get expensed all at once, so this giant dollar amount is hitting your P&L. What happens with it is it gets capitalized. And all that means is that it's going to show up as an asset on your balance sheet. And then when tax time comes around, your tax preparer is going to spread out the cost of that item over a certain number of years through a process called depreciation. And depreciation is the expense that's going to hit your P&L. So instead of taking the full hit on your P&L in the month where you buy it, you're expensing a smaller portion of it each year over what's called the useful life of that asset. So for example, computers are typically depreciated over a period of 5 years. Now, because taxes are never straightforward, there are some special tax rules that come into play when we talk about depreciation. There's bonus depreciation and Section 179 that do allow you to take more of the tax deduction or the benefit in the first year. But if you are dealing with some type of asset purchase, I really want to encourage you to work directly with your tax preparer to make sure that you are taking the most advantageous method for your business. But as far as your bookkeeping goes, just categorize these types of purchases to a asset, or more specifically, a fixed asset account, and then make sure you question your tax preparer. They can help you figure out the depreciation expense side of things. All right, category number 6 is transfers. So this one's probably the simplest of the 7, but it's still worth mentioning because I do see it get recorded incorrectly sometimes. So a transfer is simply moving money between two of your business accounts, like sweeping money from your checking account into a savings account, or maybe into a separate account that you're using to save money for taxes. There's no income, there's no expense, it's just moving money from one place to another. But this is the important step that allows you to make sure this is done right. You need to make sure that all of your business bank accounts are set up in QuickBooks in your chart of accounts. I also want to call out here that this also includes any Shopify balance bank accounts that you have. So if you have both a business checking account and a savings account, both of them need to be listed in your chart of accounts, because if only your checking account is in there because that's where all the activity happens, and then you transfer money over to your savings, which isn't on there, you won't have an accurate way to record that. Without the savings account showing up in your chart of accounts, there's nowhere accurate to assign that transfer to the savings account, and it's going to end up being recorded to something like an owner's draw or an investment, or maybe even some type of expense account, which is obviously not right. So get all of your business bank accounts into QuickBooks, and then transfers become really straightforward. All right, last but not least, liability payments. So before I jump in, just a really quick reminder that liabilities are simply money that you owe to someone else. So think of loans, lines of credit, credit card balances, sales tax, anything where you have money in your bank account that is owed to someone else and it needs to be paid back. And this category is a little nuanced because how you record the payment depends on what you're exactly paying. So I'm going to break this down into a couple different categories here. So we're going to start with loan payments. If you have a business loan or line of credit, the monthly payment you make is typically going to be split into two parts. There's interest and principal. The interest portion is a deductible business expense, so that does hit your income statement. But the amount that is applied to the principal, that is just paying down what you owe. It reduces the liability on your balance sheet. That portion is not deductible. So if your loan payment is $500 a month, you can't just record the whole $500 as an expense. You need to actually split that transaction into the interest and principal. And QuickBooks makes it super easy to split a transaction so you can break it out there so the appropriate amounts hit the right reports. Another liability payment example is a credit card payment. So when you make a payment towards your credit card, that payment itself is not an expense. The expenses were or should have already been recorded when you actually swiped your credit card and made purchases on your credit card. That's when the expenses are captured. So when you make a payment to your credit card company, you're simply reducing the balance that you owe on that credit card. It's a liability payment. So if you record that payment as an expense as well, on top of already recording the individual purchases, you're double counting those expenses, and it's going to make kind of a mess of your books. And the third category of liability payments we're going to touch on here is sales tax payments. So when you collect sales tax from your customers, that money was never yours to begin with. It should be recorded as an increase to the sales tax liability account because you owe that money to the state. And when you make that payment to the state, it should not be recorded as a deductible expense. You're just simply paying back that liability to the state. So both the incoming sales tax and the outgoing sales tax should be categorized to that same sales tax liability account, not any income or expense accounts. Whew. All right, I know that was a lot, so let's bring it all together here. Not every dollar that leaves your bank account is going to be categorized to some type of expense account. And now you know exactly what those 7 categories are and where each one actually belongs on your financial statements. So operating expenses and payroll hit your income statement. Inventory, owner's draws, asset purchases, and transfers, they typically only hit your balance sheet. And liability payments can affect both depending on what you're paying. And now when you get these categorized correctly, your P&L is going to reflect your actual profitability. You're just going to have a much clearer picture of what you're actually making and earning and keeping at the end of the year, what you can actually pay yourself, and what you should be setting aside for taxes throughout the year. There's not going to be some big ugly surprise that comes knocking on your door next April. Now, if you're sitting there thinking, okay, I get the concept, but how do I actually do this inside of QuickBooks? Like, where do I click? That's exactly what my membership, Bookkeeping Made Simple for Boutiques, is designed for. And Module 2 of the course actually walks through each 7 of these categories with detail, step by step, showing you along on video how to do each one of these things correctly. If you're ready to feel confident in your bookkeeping and stop flying blind when it comes to your numbers, come and join us. You can find all of the details and sign up at findingfreedomfinancial.com/membership, and I would love to help you inside. But that's all that I have for you today. Be sure to tune in next week for another episode. I'll see you there. Hey there, and thanks for hanging out with me today. I hope that I shared something that helped you feel just a little bit more confident in understanding all the numbers in your boutique business. If you found this helpful, don't forget to go and leave a rating and review on Apple Podcasts. That's the best way for other boutique owners just like you to find this podcast so I can help them feel just a little bit more confident in their numbers as well. If you have any questions about what you heard today, hop on over to Instagram and send me a DM at Finding Freedom Financial. I'll be back again real soon, but in the meantime, go implement or take action on something you learned today. I promise your future self will thank you.